Well, joining me now is Zaf Karim, CEO of Legendary Investments. So Zaf, it's good to have you in the studio with us.
Thank you for having me.
So Legendary Investments, it's just announced a sharp rise in the value of the assets. It holds also a swing to profitability. So how significant would you say these achievements are in the Legendary story?
Well, I think the current results are quite important because they show how quickly we are growing now. But in terms of the whole story, what you have to do is, if you go back 7 years ago when we rescued Legendary as a shell, we had no assets, we had no investments, and we rescued the company with a few tens of thousands of pounds.
Yeah.
If we'd made 600,000 then, it would have been not significant, but mind-blowing. We've grown that to 6 million of investments, 6 million of net assets. And in that time, we've only raised about £2.6 million after costs, excluding the SP Angel raise recently. So most companies could not run on £2.6 million for 6 or 7 years, let alone make investments and grow them. Now we're at the size we are, we expect to grow faster and more quickly. So a 10% rise in our assets, again, will be another £600,000. So while it's an important number, in terms of significance, in terms of how big we are and how fast we're growing, we can do better and expect to do better.
Yeah. So then, how would you categorise Legendary Investments? Are we looking at an investment trust-like structure, or angel investor, or venture capitalist? I mean, how would you summarise?
So we are not an investment trust. Investment trusts typically invest in listed companies, and they're passive investors, as in they invest and then they may vote their shares one way or the other. If you are a private investor with sufficient resources, you can replicate that. And so investment trusts typically trade at a discount. First, we unlock opportunities in the private market which other investors would not have access to. So you can't replicate what we do.
Can I just say, let's move to the next slide, because I think this will help you explain it.
Sure, you can't replicate what we do. The second thing is we are very active. So we don't just vote, but we get involved in the companies, help nurture them, help grow them. We try and minimize the risks associated with them and maximize the potential. We bring big thinking and we bring credibility. We make the companies safe to buy from. And so again, that's very unlike an investment trust. Yeah. We almost mentors, coaches, the pseudo-executives, if need be, in the companies. So the investment trust model doesn't apply to us. In terms of angel or VC, that's a spectrum. One is very early stage startup or blue sky, and one is more mature companies. We're somewhere in the middle there. We're not quite startup, but we're not VC. In fact, often investors that after we've done our work, a VC will get involved. So that's where we are.
And on the risk spectrum, then you're somewhere in between as well.
We're somewhere in between, yeah. But I'll get on to track record and you'll see we've managed the risk quite well.
Yeah. Okay then, well, talk me through the track record. What are we seeing here?
So typically, if you're a PE type investor, you expect to get 1 out of 5 spectacular results, 3 wash their face and 1 goes bust. A VC typically is 1 out of 15, 4 go wash their face and 9 go bust. Blue sky is 1 in 100. Yeah. We've had 5 out of 12 right. I think that's quite spectacular. Yeah. And the returns have been from 1.5 times, 1.4 times to currently 33 times and in counting. So that's quite something. 3 of the companies we've invested in have listed. I said we get involved in private opportunities, unlock them, and then they list. And the returns are much higher than if you get in at listing, typically.
Okay, well, looking at some of the stats, I mean, you've gained 33 times your initial investment in virtual stock, also a share of 10 million haul in IBS, it's the New Zealand Financial Services Group. So I suppose the question lots of people are asking is why you don't just sell out and realise these gains?
Well, the thing is this. With virtual stock, we got in at a 2 million valuation 6 years ago. And these things take time to build up. Now we're sitting on a valuation 33 times higher, and that's a backward-looking valuation. Even since then, the company has pretty much doubled its revenues, and so one can draw own conclusions about valuation. Say if virtual stock doubled again, that would add another nearly 5 million to our balance sheet. Yeah. So if we got out now, it would seem silly, unless you think virtual stock won't double. but it's grown 33 times, but it's just doubled its revenues. And an analogous company in the US has been sold, virtual stock's valuation at the 33 times valuation is 66 million. An analogous US company was just bought for 6.5 billion. So if we got out now and tomorrow virtual stock was bought for 200 million, we'd be criticised. We think there's a lot more to go. And now we don't need much to happen to capture that. So we won't sell out.
Well, let's just turn to the next slide, which I think is your March update. But before we talk about that, just a question on that. And do you think it then is a challenge for you to talk to investors in terms of the complexities of the investment banking industry and also this longer time frame that you're looking at that perhaps a retail investor might actually be used to?
Well, let me answer the second part first. So in terms of long time frame, because of what we do, when we started out, there was a long fuse, a slow-burning fuse. But now a number of our investments are coming to maturity. Virtual stock, IBS, Crowd for Angels looks like it's doing well. Dunraven looks like it's doing well. And we have a pipeline of other investments as well. So we can expect more frequent realizations than before. We've already made realizations in 2 or 3 companies anyway, at 1.4 times, 4 times, et cetera, 1.5 times, whatever. But we can expect those, because we're more mature, we can expect more of those. Yeah. So that addresses the timing issue. The second thing is in terms of complexity. Look, when we invest, we place an inordinate amount of stress on the quality of the management and whether they know what they're doing, whether they have the expertise. I'm not an expert in what virtual stock does. I'm not an expert in what Dunraven does. But I'm convinced the management team are. And we also look at the sector and whether it has potential for massive growth, etc. But the management team are key. I rely on their expertise. We've done fairly well out of that. So, you know, investors can take that same kind of viewpoint. Our expertise is finding these good companies and doing what we need to do to make sure they grow.
And just another question on what you were talking about before about why not just selling out. I mean, surely the stock market prefers these smaller realised gains rather than large notional gains, albeit if they're off the back of old valuations.
You know, one could argue that, but in terms of the stock price, if we go to the next slide, you'll see that the last time our price was at this level was early 2016. And we've spent a lot of time focusing on the underlying business and a little time increasing the exposure of the company. And when we did that, the stock price quadrupled. But there were no realizations there. It was just that people realized, my God, this is undervalued. Now the stock price is about those levels, but the company is much stronger. And, you know, events like this where I guess a lot of people will see this and make their own mind up as to whether we're undervalued or not, and that should have an effect on the share price. But that can happen without realizations. But realizations are likely to be more frequent. Take virtual stock again. The CEO said that their ambition is to list on NASDAQ within 2 years or so. So that's not that far away.
So we don't have a great deal of time, but final question for you. And considering we were just seeing the share price there, you don't think investors should be too concerned now about it being a lot lower than it was the peaks of 2016?
I think on the share price, of course, I can't comment. All I can say is the company is far stronger than it was. The balance sheet is far stronger. The underlying investments are far stronger. And even since that balance sheet was down, our net assets have risen some more post-balance sheet. And so investors can draw their own conclusions from that.
Super, Saf, thank you. Certainly an interesting one to watch.
Thanks very much, Jenny.